Welcome to the Coin Stories podcast, where we talk about investing, hard money, Bitcoin, and how technology is revolutionizing the global economy. I'm Natalie Brunell, and I'm here to learn with you. So this is for educational and entertainment purposes only. None of the discussions should constitute as official investment advice, and you should always do your own research. Make sure you're subscribed to my page so you don't miss out on any new content. This show is made possible through partnerships with companies I trust, and I'm very picky about who I partner with. So I hope you take the time to listen to the ad reads throughout the show. First up, Swan. I partnered with Swan because it is a Bitcoin-only company that is focused on helping people save for their future and self-custody their Bitcoin. Swan can help you start a direct deposit to take advantage of Bitcoin as a savings technology and learn how to take it off the exchange. Swan also offers retirement planning with an IRA, tax loss harvesting, and a white glove private client service. I use Swan to dollar cost average, and I deposit a little bit every day that's equivalent to what I might spend on a meal so that I add to my future nest egg and lower my yearly cost basis. Swan Studios produces my hard money news reports, simplifying Bitcoin for mass audiences and documenting Bitcoin adoption around the world. To learn more and get $10 in free Bitcoin, head to swanbitcoin.com/Natalie Brunell. All right, next up, Bitcoin Conference 2024. The world's largest Bitcoin event is headed to Nashville next year. Early bird tickets are now available, and this is the lowest cost you'll be able to secure for the conference all year. And if you use the code HODL, HODL, you'll get an extra 10% off. So come join us for 3 great days of networking events, panels, keynotes, workshops, and more. You never know what big name might be announced when tickets are much, much higher in price. Head to b.tc/conference and use the code HODL. I'll see you there. All right, it's time for the show. Hi, everyone. Welcome back. One of my most popular guests is back on the show today, David Hunter, a contrarian investor. And I'm so excited to chat with you. I'm actually titling this episode, Where is the Melt-Up and Deflationary Bust? And I know you have a lot of takes on that. So David, thank you so much for coming back.
Sure, Natalie. Thanks for having me back.
All right, so first, let's just zoom out. What is your take on everything that's happened with the markets? Because one thing I know we have talked about in the past is how good we are here in the United States and the economy with kicking the can down the road and being able to, let's say, avoid a hard landing or a recession. But there are a lot of indicators that say that a hard landing might be coming. And I know you have a lot of takes on this. So what's the big picture?
Yeah, I'm still looking for a hard landing, what I call a global bust, and I'm still saying it's going to be the biggest downturn in financial crisis, certainly in the post-World War II era, so bigger than 2008-9. And I know that's hard right now because everybody's moving the other direction towards soft landing. But there's a lot of stuff in the the leading indicators and looking at credit, et cetera. There are a lot of signs there that things aren't as good as everybody thinks. And as you know, not many months ago, people were glad to buy into the global bust scenario, and now they're moving away from it. And that's just kind of the ebb and flow of the economy. I've been surprised by the ability for the economy to stay resilient and for the consumer to continue going. But a lot of that, I think, has to do with the pandemic. Mm-hmm. I mean, we just had so much fiscal and monetary stimulus pumped in during 2020, 21, and it just doesn't go away that fast. It's still in the pipeline. So it's allowed consumers to continue to spend. One thing that surprised me, and nobody talks about it, but we really had people using for many, many years using the refinancing vehicle of their home equity to, take money out of their home and keep spending above their means. And with rates moving up 500 basis points, that took that away. So we really see very little of that anymore. And yet the consumer has remained resilient. What they have done a little bit is they can't do it all at once. So for the the period during the pandemic, they spent on goods and things on their homes, etc. Now that the pandemic's passed us and everybody feels comfortable traveling, they're putting aside some of their spending on material things, and they're traveling. So they're not doing both at once, but they're, it's still the US, it's still shop till you drop. And they just aren't, they aren't giving that up yet. even though they're they're using credit cards for everything. I
Mm-hmm.
mean, credit card um, uh, credit on credit cards is the highest it's ever been,
Yeah.
and it's moving up rapidly. And you're seeing it in, they're using it for groceries even. So that's a bad sign. I think there are lots of signs that we're moving towards a tough economy, and because of leverage, I think it will be a bust. But it just takes time to work through the pipeline.
Yeah, I know. I saw that there are a lot of credit card delinquencies. The government is still spending a lot of money. And I wanted to ask you a little bit more about the mechanics, because it seems like the reason that we're able to keep going and that the government officials are saying that the economy is so resilient is we really did blow up the bubble so much. And all governments around the world did it in response to the pandemic, that it seems like there's still a lot of liquidity that is sloshing around and needs to work its way out of the system. But now we are seeing some of those indicators. There have been insolvency issues with regional banks. The commercial real estate looks really weak as that debt rolls over. So can you talk a little bit more about sort of like how big we blew up this bubble and why that's the reason maybe we're seeing this drag out and we haven't hit an official recession?
Sure. Yeah, it is. I mean, I think we throw around these numbers, trillions of dollars, but I don't think anybody really stops and realizes, in 2008, going into the Lehman event, the Fed's balance sheet was 875 billion. It blew up to, I don't know, two and a half um, 2.5 trillion, I guess, by the end of the 2008-9 crisis. We're now, just below 9 trillion. We went up over nine, and we pulled back a little bit, but we put 5 trillion into the system, where the Fed expanded their balance sheet by 5 trillion in during the pandemic. I mean, so you go from 875 being the entire balance sheet going back to 1913 when the Fed started, and in just these, in a short decade plus, we've gone to 9 trillion. I mean, trillions matter. I mean, that's big money. And equally, I mean, we've gone on the government side to 30 trillion plus in debt,
Mm-hmm.
just on U.S. government debt. So, and 300 trillion in global debt. So we're talking about numbers that are way off the charts. And I think we just kind of hear them, see them, and move on. But they matter.
Mm-hmm.
And so when you put that much stimulus into the system, it doesn't all get spent in a year or two. It kind of works through the system. And then, of course, you've got home prices moving up. You've got borrowing on the private side at levels we've never seen. So it's across the board, just massive leverage. And it will matter at some point. Obviously, the big question is when.
Have you been surprised at their ability to raise interest rates as fast and as aggressively as they've been able to without sort of breaking something in the system? I mean, there have been definite cracks, but they've rushed in to sort of save it, right?
Yep. I mean, we saw it in the spring, obviously, the regional banking issue. So we did get a crack. And now we've settled down. The Fed kind of pumped some money in and took care of the few banks that were in trouble. We just had yellow freight go under because of debt. Um, there are plenty of cracks under the surface. It's just the nature of the economy that it takes time. And forecasting, you can expect things to happen faster and they take longer. It doesn't mean they're not going to happen. It just means we're not there yet. But the thing I've learned through all my years of doing it and through several cycles is it can look like it's a ways off and come very fast. And I use 2008 as an example. In September of 2008, I was calling for a hard landing. Every economist on Wall Street was saying soft landing, no recession in sight. We were literally 3 weeks away from the biggest financial crisis in the post-World War II era. And people didn't see it. I mean, people trained to see it didn't see it. So I'd say the same thing here is it can happen at any time. My guess is it will be in recession before the end of the year. Some people would tell you we're in a recession now if you look at certain things, but ultimately, I think recession by the end of the year and bust next year is still my call.
Well, let's talk a little bit more about your forecast, starting with equities. There have been only, a few companies within the S&P that have outperformed all the rest, and we have seen a rally on that side. It seems like people are really confident if you look at just the stock market. Can you talk maybe a little bit about some of the nuances and where is the melt up that you were calling for?
Yeah, some people think we're in the melt up. I keep saying no, the melt up hasn't even hit yet. But we've had a big rally from last October from 3,500 up to 4,600, and obviously pulling back a little bit here. So, I mean, that in almost any other period of time would be considered a big bull market. However, because sentiment was so negative and people were so worried about what the Fed is doing and overkill, et cetera, they fought that rally the whole way up and said, no, it's a bear market rally. It's a bear market rally. We don't believe it. We think it's going to end up going to new lows. And only, I think, probably once we got above 4,300, did some of those bears begin to move the other way and say, oh, I can't fight this any longer. But the thing is, there's still, I call it bullishness with no conviction. The minute you get something like you're getting the last couple of days, people start pulling out the bearish, narrative again. So there's really a lot of skepticism about this rally, and rightfully so. The valuations are high historically, but I would say we're in the process of moving towards the melt up. The melt up is what I call the final stage, the parabolic stage. And we are still climbing a wall of worry. We're in a nice bull market. It's a new bull leg. But I believe once we get to new highs above 4,800 is probably where you're going to see the slope steepen even further. And you're going to have, pullbacks are going to be very short and, very quick. So you'll be, up, and people have to chase. And people look at the valuations and they go like, I'm still calling for 6,000 to 7,000. And people are going, how in the world are you going to get there given that we're already at historic valuations? But it's because people will believe we're entering a new cycle, but the Fed tightening cycle is over. They can look over the trough and begin raising earnings estimates for next year. And in doing that, valuations come down. So I think that's still ahead of us. I think it's directly ahead of us. This pullback we're having now, I think, probably doesn't last very long. We could get 3, 4, maybe 5% pullback. It's always possible it's bigger, but I think, given how many people fought this thing, I think you get down 3, 4, or 5%, and people are going to be coming in trying to catch up again.
Well, the Fed recently raised rates yet again, 25 basis points, because inflation is still too high. And I think there's almost a tug of war, especially when you look at the analysts out there, between an inflation narrative and a deflation or disinflation narrative. There are so many factors that indicate we have a decelerating economy. But at the same time, if oil ticks up, some people are predicting that maybe it could go to 100 a barrel. That's the number one input for prices. So things could go up again. Some people are predicting even a double-digit CPI next year. So I wanted to get your take a little bit, because how do you see this all playing out? Because if oil were to go to 100, I mean, that would cause potentially a crisis in the bond market, wouldn't it?
I don't know about a crisis, but it certainly would push inflation fears higher and inflation expectations higher. But at the same time, assuming gasoline follows along with that, it's going to tighten the consumer pocketbook even further and leave them with less discretionary income. So, it's kind of the yin and the yang. Which one do you pay attention to? The impact on the economy coming, going forward, or the inflation that's hitting right now. So I don't happen to believe we're going to 100. As you know, probably I've been the bear on oil all the way down. And I think we've been in a trading range between the mid 60s and mid 80s for most of last year. And I think it's going to remain in that trading range and probably roll over and head back down towards the lower end of that. And because I think the bust is not that far off, I think ultimately oil goes to 30. So next year. So, there's always, and people they fought the downturn in oil for a long time until it kind of broke 75, I think. Then they started getting on board and saying it's going lower. But I think people still look and say, gee, oil has to go higher. And I don't think so. I think, again, we talk so much about the US, and my focus is the US, but globally the economy is weak, and I don't see that changing. So I still think oil's probably going to stay in that trading range for a while longer.
It's time for a quick break to hear these messages from my partners. Fold is the best Bitcoin rewards debit card and shopping app in the world. You can earn Bitcoin on everything you purchase, from Amazon to groceries to your Bitcoin conference tickets, with Fold's Bitcoin cashback debit card. And you can win free Satoshis every day, or even play for a whole Bitcoin by spinning the rewards wheel. You can also buy Bitcoin and stack sats directly on Fold and earn even more incentives and rewards. This is a great app to get someone totally new into Bitcoin, and way better than earning airline miles or hotel points. Head to foldapp.com/Natalie, and if you use my link, you'll get up to 10,000 sats when you sign up for Spin or Spin Plus and spend at least $20 on the card. I'm so excited to share that I have partnered with Coinkite, and we are committed to making sure everyone has the information they need to safely self-custody their Bitcoin. Coinkite produces the ColdCard wallet, which is the cold storage device I am switching to for safekeeping my Bitcoin. It is Bitcoin only. You can verify the source code. It's ultra secure. And as I'm learning, it's easy to use even if you're a beginner. If you head to their site in my show notes, you can find all of their products, from cold cards in different colors to seed plates, tap signers, sats cards, block clocks, which I have behind me, and more. I'm also in the process of creating some how-to videos on ColdCard, so watch out for those in the near future. Become your own bank with Bitcoin and Coinkite. All right, back to the show. Well, I want to ask you a little bit about geopolitics, but first, just wondering, why do you think gold has underperformed? I mean, in these conditions, you're certainly not the only person to believe that we're headed toward a hard landing, and that maybe people need to protect themselves with some hard money and something outside of the purview of the government being able to just print into oblivion. Why has gold underperformed?
Well, if I you probably think it's because of Bitcoin.
No, not exactly. I mean, Bitcoin's up 50%, but it's just certainly, it could be doing better for sure.
But obviously that narrative is out there that Bitcoin has taken some of the demand away from gold. And maybe that's true to some extent. But I think the real thing is the dollar, up until this past year, skyrocketed, and that really hurt gold between March of 2022 and October of 2022. It got hit hard, and it has been coming back, but it's a tough climb. Every time you start thinking you're about ready to go, takes another step back. But I would say the trend has turned. It started turning last September, October. I think we're in a new bull market in gold. And I'm still calling for 3,000 gold, probably in the next 6 to 8 months. And silver, similar big move. But the dollar's been in a counter trend rally here in the last couple of weeks. And that's held gold back. Interest rates rising here is obviously putting pressure on it. So it's kind of just got to work through some of those things. But again, I think gold will, as people begin to feel the tightening cycle is ending, they're gonna that headwind that has been holding back the metals is going to become a tailwind, and I think that will be a big part of the move. and I'm still very bearish on the dollar, and I think that will be, a big tailwind.
I know you face a lot of criticism because you can't really predict the timing on your forecasts, right? So people have been asking, where is this bust? Can you talk a little bit about your forecast, why you still have so much conviction in it, and maybe your response to some of the criticism?
Sure. Yeah, actually, on Twitter, I get a lot less criticism these days because I was pretty much the only bull standing over the last 9 months. Everybody was bearish and fighting it. So a little premature to pat me on the back. I mean, we haven't got to the mill top yet, but at least I'm not getting the you're an idiot calls every other tweet now. So I've gotten smarter as the market's moved up, I guess. But yeah, I mean, it's taking time, and I keep pushing out the time frame. And as I say, my time frame is, it's a big cycle call, so it's really a, when the market decides to move in the cycle, that's it. And when I put out any kind of time horizon, say it could happen this quickly, it could happen in the next several months. But then when it gets there and I've pushed the timeline again, you get the critics out there saying, "Hey, what are you doing? Anybody can just keep extending cycle." Well, the cycle gets extended by consolidations in the market and by the economy being able to stay resilient. So it doesn't mean it's not coming; it just kind of pushes it out. In terms of what else did you ask me?
Oh, no, just, in terms of the forecast, why you still have so much conviction that it
Oh,
will
sure.
play out in the way that you
Yeah.
think.
Yeah, it's the big picture call. As I keep saying, we're in the last decade of a super cycle, and I expect that we're going to go to higher highs on the market, and have expected that, even though it was down a lot last year, and that there is this final move to in a blow off top, and that we will make what I think will be a secular top of a bull market that's been in place. A secular bull market's been in place since August of 1982. So we're in the 41st year. The anniversary is this month, and I just don't get worried about even months or even a year when you're talking about such a long secular move. And I do think you have to get to that top and then go down the other side of the mountain. I think the other side of the mountain will be quick, relatively quick for how big a bear market and bust it will be. But there's so much out there in terms of the debt, the leverage on the system,
Yeah.
and the weakness that came, or what I call the fragility that came as a result of the pandemic. When you combine those two things, and then look at a Fed, but also central banks around the world that are making the same mistake they make so many cycles, which is looking at the here and now and wanting to see the evidence of their policy, even though they give lip service to the fact that it's a long and variable lag. Their actions tell you they don't really pay a lot of attention to the lag.
Completely.
They want the evidence of their policy move in front of them, and that means by definition they're going to be late. And when you're late in a normal cycle, it causes a recession, and maybe a bad recession. When you're late in a cycle where you have debt through the roof like we've never had in history, leverage on the system, including derivatives like we've never had, that mistake gets magnified many-fold.
Completely. Well, I think that this is such an important message to get out to the general public that doesn't have, a lot of financial education. And the narrative before from our officials was inflation is transitory. Now the narrative is we're going to be able to have a soft landing. I was wondering if you could kind of explain why this debt is so unsustainable, why it's really impossible for us to have a soft landing, for us to get to, a normalized 2 to 4%, Fed funds rate with this much leverage in the system. I mean, our interest expenses are going to be exceeding the military budget now. We're running, I think it's $1 trillion a year. So we're paying our Visa with our MasterCard, right? We have to go further and further into debt. And at some point, this can't go on.
Yeah, we've gotten into an insane policy, and I think they may not be talking about it, but I think that basically the party in power is really managing the economy and managing the budget using MMT, thinking, we can expand debt inevitably, not to infinity, but certainly a lot more, and just use the printing press to pay for it. Well, what happens is that, and we're seeing that play out in front of us, or it did in the last couple of years, is that when inflation breaks out, it really starts to tie your hands as a printing press. It tie the Fed's hands or any central banker's hands. And so all of a sudden you've increased the cost, you've increased the leverage, you've increased the debt, you've increased the cost of servicing that debt. And then the Fed has to react to that, move rates up. That increases the cost further. And as you say, all of a sudden you've got interest costs that are, it's a debt spiral, and a cost spiral where you can't solve that equation. Mm-hmm. So the Fed understands it, and the central bankers understand it. That's why they're tightening, and they get a lot of criticism because people don't like the pain. I understand what they're doing. I just worry that they don't understand the leads and lags. But the real story, because they will have a printing press during the bust, because I think it will be a deflationary bust, they'll be able to print their way out of it. Not that it's a good idea, but it's inevitable that if you go through a huge break in the system, meaning bank failures around the world, financial crisis around the world, just like in 2008-9, the central bankers will come in. That's the easiest prediction I can make. They won't have a choice. And the thing they will come in with is a lot of money, more money than they've ever printed before,
right?
By many fold. So they will save the system one more time. The real issue comes later this decade,
right?
When all that money that's created, and I think the 300 trillion debt that we have now globally will grow to something like 450 to 500 trillion. So by the end of the decade, you have so much more debt that you couldn't manage when it was at 300, and you'll have inflation because of all that money printed with a lag that will be in the double digits, and probably high double digits. I predict by the end of the decade 25% inflation in this country, interest rates between 15 and 20%, and you can't solve that equation. I mean, basically, the Fed will have no printing press because you can't pour money. You can't pour more money onto a burning fire. I mean, so they will be shut out of the printing press will be shut down. The government, we've already seen Fitch downgrade us to AA.5, and basically, I think by the end of the decade, probably sooner, we'll be pretty much shut out of the capital markets. The government won't be able to say, we need more money, we're just going to sell more bonds. There'll be no takers, including the Fed, because the Fed can't print more money, which is what the Fed does. They monetize the debt by printing more money and taking the debt up. So they're a buyer of last resort. Well, that buyer of last resort is going to be gone. So that means you're going to have a government that all of a sudden has no access to more capital, has no access to the Fed, and yet has, the equation looks like, if I'm anywhere close to right, interest will be the entire budget. You'll have no money left over for anything. Obviously, for a few years coming out of the bust, meaning coming out of next year's downturn, for a few years, they'll try the game of printing more or floating more debt to pay to service your debt. I mean, that becomes,
Right.
rat on a wheel very quickly, and you can't keep up with it. But for at least a couple of years, inflation will be coming out of deflation, so it will be low for a year or two, and they'll be able to play that game.
Mm-hmm.
I think by 2027 or 8, that game's over. And the reality hits that we really don't have, we have to live within our means, and we don't have any way to get there. So, I'm predicting, as you know, I'm predicting a collapse in the 2030s. And this is, again, the US has done a terrible job of managing their resources and, running a government. But this is happening all over the world. And
yep.
So it's basically, it's the end of a super cycle. It's the collapse of the system that built up over many, many decades and reached excesses that just got ridiculous.
Yeah, well, I said on Fox Business News once that a nation that lives by the money printer will die by the money printer. And, Stanley Druckenmiller has pointed out in recent talks how we have to cut our obligation spending. And that's something that no one seems to have the political appetite for, right? Reducing things like Social Security and some of our other major expenditures. But we have to cut spending. We're spending too much. And it seems like, countries are starting to realize that they need to move away from the dollar. I think that will still obviously, take a while because the dollar is the global reserve currency. And that's one of the reasons why we've been able to get away with printing so much money, and we've exported our inflation and we've created this massive wealth divide. I truly think that quantitative easing and monetary policy has led to just a total erosion of the middle class, a destruction of the American dream. When I hear MMT, I just think financial repression, and they will not be able to print their way out of this. For me, for a lot of viewers, we think that Bitcoin is certainly a life raft, but hard money in general, moving into something that the government cannot print. I wanted to actually touch on geopolitics for a little bit, because you are seeing more countries saying they're going to settle trades in different currencies. They're talking about backing currencies with gold. We're seeing, even though gold has technically underperformed, central banks are purchasing it, and they are having more and more of their reserves in gold than ever before. So can you talk a little bit about what's happening geopolitically, maybe, BRICS, this new currency system? We have potentially a debt crisis in Japan, the NATO struggle in Europe, the rise of China, our rise in chaos in Africa, potentially a Western power vacuum. I mean, what are your thoughts on all of this?
Yeah, when you step back, you look and you say, we put ourselves in a big corner. Mm-hmm. And I think we were helped into that corner by our enemies. I think this thing has been, I don't want to give too much credit to China or Russia in terms of geopolitics or how they operate, but basically, and adding New World Order, basically, the U.S. has been played a lot, and we've played right into, I think, strategies that are aimed at bringing us down. And so, it's both from without and within. New World Order seems to be kind of the establishment agenda. And I think it's certainly one party, but I think both parties are part of it. And there's a lot of people in Washington that are not Democrats that are helping feed the New World Order move. And I call New World Order code for a communist takeover of the world. So I think they're playing, whether they're useful idiots or whether they are playing, are partners with the communists, it's going to the same place either way. And I think we are, again, ultimately, I think the whole world collapses. So I don't think there's a winner and loser in this. But we certainly didn't help ourselves in terms of playing right into this. We gave away our industrial base. You look at the pandemic just in healthcare. None of us knew until we woke up in the pandemic and found out most of our medical supplies are sourced through China. I mean, did we know that before that? I don't think so. We knew steel was pushed out of this country, and a lot of other industrial base was pushed out under the guise of comparative economics and globalism. We killed our economic base.
Yep.
And we moved to being a consumer society. Didn't care where the products came from.
Yep.
I mean, that's just, when this is looked at down the road, it's going to be, what were we thinking, and how did we get caught up in this? So that's there. In terms of the reserve currency and what the BRICS are doing and everything, my take is that we're heading for this global bust next year. It's going to derail so much of that. I mean, as you know, the Austrians have been pushing a gold standard for a long time, and very critical of central bankers, rightfully so. But to come in and to think you can somehow solve that with a gold standard now, I like to say we'll all be living in caves. I mean, you can't be where we are leverage wise and system wise, and all of a sudden at this point instantly say, okay, it's time. We're gonna, it basically, you're gonna fast forward what I say is coming anyway, which is lack of access to the capital markets. You're gonna all of a sudden have no access to any capital anywhere. The gold standard would pretty much do that immediately. And so I don't think that's realistic. We're not going to see that. And I understand what the BRICS are doing, led by Russia and China. It's a way to put it even further into the corner and take away the dollar as that. We've used it as a we've used our clout around the world, as you say. It's allowed us to really do what we've done. And they see it as a way to take that away. I just don't think it's going to put much of a dent in it for a while, and I think the bust sidelines it anyway. So get out later in the decade, and I think there's a lot of things that are going to be happening that are going to just put us farther back. Including, I think, we're going to do it to ourselves. Our reserve currency status is going to disappear or be diminished, simply because people are going to say, well, why do we want to, we don't want your dollars. Look what you're doing to your system. So I do think it's coming. I just don't think it's coming in the way everybody expects, or that you can, I don't think it's the next 2 years. I think it's more, the balance of this decade is going to be tough, and we're going to be moving in that direction. And then the next decade, I hate to say it, but it's, if we can't afford anything but servicing our debt, we're obviously either going to default on our debt, or we're not going to be able to sustain all those things that people look to. We've become very government dependent. I don't see, as I say, we could have in the next decade, meaning in the 2030s, a unemployment rate of 50% or more in a depression, with no welfare system to speak of, no unemployment system to speak of, or unemployment benefits to speak of, very limited, if any, Social Security or Medicare or Medicaid. It's a dire forecast, but I think we have taken this thing so far beyond any ability to bring it back that I think the only thing that happens is a collapse. All the other things that people are projecting of how you can see us kind of fall by the wayside gradually, I think are less likely. I think it more is a U.S. collapse, but certainly a global collapse.
It's time for a quick break to hear these messages from my partners. Next up, I want to share with you about CrowdHealth, which is a Bitcoin alternative to health insurance. Health insurance costs are sky high today, and you send your money every month to a massive corporation, and then you never see that money again, even if you don't need a doctor. But if you do need care, you end up having to pay even more out of pocket, especially if you end up as one of the 20% of claims on average that aren't covered. CrowdHealth is all about community, and the community crowdfunds everyone's healthcare. So if something happens to you and you need medical care, CrowdHealth negotiates down the medical bill lower than what insurance would be, and then the community helps you cover it. And in turn, you help cover others' needs, which has been so rewarding. I am so glad I switched to this program. And for more information, you can head to joincrowdhealth.com/Natalie and use promo code Natalie for a discount. I am so excited to share that I have joined Orange Pill app as an advisor. If you haven't downloaded this app yet, you are missing out on connecting with Bitcoiners in your area. The Orange Pill app is building the social layer for Bitcoin and helping to create opportunities for in-person connections and community building. You can create a profile and you will see lots of familiar faces there. And then you can search for Bitcoiners or Bitcoin events based on your location. I am geotagged in my home base, St. Louis, and I'm super grateful because the Orange Pill app has helped connect me with Bitcoiners in my new city. So come join us, download the Orange Pill app, and head to theorangepillapp.com for more information. It's really sad to think about how we've sacrificed free markets and really been seduced by imperialism. And when I hear you say that there's going to be this global collapse, I would have completely agreed with you had it not been for learning about Bitcoin. What's your reaction to that? I know that you have sometimes Bitcoiners reaching out to you. I don't know if you've taken the time to study it a little bit more, but so many people now are finding hope in this idea that through technology, there can now be a hard money, one that is totally global, cross-border, peer-to-peer, that can't be manipulated or inflated. And they see hope in that for potentially solving some of these really deep-rooted economic issues and this system of debt that's going to eventually come down.
Yeah, I guess my short answer is just that the macro overwhelms any of that. I don't doubt that Bitcoin, for some small fraction of the population of the world, will be a savior or will be something that helps them. I just don't see how it solves the problems that we've created. We have this. It's a spit in the wind compared to what's coming, I think. So I get the attraction of getting out away from government manipulation and having something that's based on supply and demand and not everything else. But I just if this were 30 years ago, I'd probably be much more optimistic about it. But we're so close to, I think, that end result, and I just don't see how that can make up that divide. It's just huge.
Well, it's going to be interesting to see how the battle plays out between the forces of freedom, right, and individual sovereignty, which Bitcoin fits into that, and the forces of control. And I think that we're in the midst of that right now. As we start to wrap up, let's hopefully end this on a positive note. There are still opportunities, right? And you certainly always talk about that. Where are the opportunities, and how can people protect themselves, protect their wealth, and plan for their futures, especially if they have families?
Yeah, near term, obviously, I'm calling for from here still 40% plus, maybe even 50% upside in markets. And I tell people, even if I think it's happening this year, which is insane, and so your time-wise very close to a big bear market, because the other side of this is an 80% bear market, in my opinion. Even though it's short-term in nature, it's like 3 years worth of return, 3 or 4 years worth of returns in the next 6 months or less, if I'm right. So what I tell people is it's easy to get big picture and worry about all the stuff we talked about and miss something. And my fear is that people will miss it early on, as they have, and then come in at the end, because I can pretty much predict at the end, meaning at the top, almost everybody will be bullish. That's the nature of the psychology. So if you say, well, no, I'm going to be, I'm going to be conservative here, and I'm going to, keep my money safe, you're probably going to be lured in by the psychology, by the momentum of the market at some point, because it'll be convincing. People will say, oh, the cycle's, the down cycle's behind us. It's more than a soft landing. We're actually starting a new cycle. It's, big things ahead, AI, et cetera. So just be aware of that. Whether you choose to play in it or not, be aware of the psychology and what can happen near the top because it's going to be very compelling, I think. Um, and and longer term, meaning the next several years, and I call next year, I talk about standing on the south rim of the Grand Canyon, looking across the north rim and thinking you can walk across. Next year is the Grand Canyon. Next year is that bear market. And, beware that if you're somebody, it's a buy and hold person and says, well, I can't time the market. I'm just going to hold through it. Next year is going to be unlike any bear market we've had in the post-World War period. I think it's an 80% bear market. It's going to hit across all segments of the market. So just be aware that there's real risk ahead. But beyond that, the longer term picture, in my opinion, the story between now and the end of the decade is commodities. I expect oil to go to $500 a barrel. As I said, I think it can get to 30 next year. I expect gold to go to 20,000. I expect it to go to 3,000 pre-bust and then probably back to here in the bust. So, silver could go to $400 or $500. All the metals, all the commodities, I think, are going to be in big upward spirals because of all that money that gets created in the next couple of years to deal with the bust. But just understand, and so it won't be the same leadership as we've had. I mean, tech's been great. I'm sure AI is going to have a big role in the next market, but the real story is new leadership, and the new leadership in the cycle that follows the bust will be commodities and precious metals. And then just understand that it's a cycle, and that all good things come to an end, and that will too. So whether it's the end of the decade or early next decade, all of that will top out just like tech will top out here, and you'll go through that what I think is going to be a tough 2030s.
I wanted to ask you, David, because when I was a news reporter, I covered the fact that 50% or more of Americans, they don't own stocks. They don't have assets. The average family can't afford a $400 emergency. How does someone who doesn't have a lot or lives paycheck to paycheck, how do they navigate and try to accumulate some amount of wealth?
Yeah, it's a tough question, especially today, because inflation, we had 30, 40 years of disinflation, where you had a chance to actually maintain a budget and put away money. And unfortunately, we became such a consumer society that so many people learned the wrong lessons that I have enough money to have a happy life. I can do this. And they don't realize at some point you have to have that savings. So now you're at that point where inflation eats up everything. You get a raise and it doesn't account for anything because it's eaten up by inflation. So it is. I don't have an easy answer for people. The one thing I will say is you look at first generation Americans, and some of them get ahead simply because they know how tough they had it in their old country, and they see opportunity and take advantage of it. I think in our country, too often we overlook the opportunity. Yes, it takes hard work. Yes, it means foregoing things you want now. But that's the difference. I think the first generation American appreciates that we still have a land of opportunity. It's not an easy one, and it's not what it used to be. But if you really want something, figure it out and forget the material accumulation. I feel sorry for the young people that are seeing what happened to housing in the last couple of years and say, I was going to buy a house. I put away some money and now I can't do it. But then I see the others that are leaping in and taking on debt that they'll never be able to handle, particularly if we have a period of time where their income gets jeopardized. And yet they're so anxious to have it now. And unfortunately, we're not promised those things. And I think, at least from my perspective, it's get your house in order financially first. And debt is that is something that helps you on the way up, but it really hurts you on the way down. And I'm not sure enough people understand, you know, this, what little time we have left before what I think is going to be a global collapse. Get your house in order. Don't look to expand, and don't buy a Tesla and borrow most. If you don't have the money for it, don't go out there and get $1,000 a month car payment just because you can afford to pay it every month. I think it's really the ones that are going to have the best chance of surviving what's coming, I think, are those that are frugal and careful with their money. And if you can put a little away, understand markets go up and down, and that it's been a mantra out there for a long time that, you just put your money in markets and just let it sit there and it'll grow. The cycle that's coming is not that. The cycle that's coming means you better pick the right spots and the right times.
Right. That's such good advice. Savings is so important so that we can plan for the future as opposed to some of the short-term thinking we see so many people resort to. David, it's always such a pleasure to talk to you. Thank you so much for coming back and updating us on your forecast, your analysis. Any final thoughts?
Yeah, just because bonds are in the forefront right now and rates are moving up, I just should probably touch on that and say, I may be wrong, but I still believe that most of the rate backup is behind us, that we're going through the last stages of a counter trend rally in rates, and that ultimately rates are going to roll over because the economy is going to soften, and that the next year ahead is a time where you can be in bonds. The interest rates are likely to go back to new lows, below the 2020 lows, because of what's coming next year in terms of economic weakness. So for those that aren't comfortable going into the stock market, you can, and the government's still okay right now, you can buy government bonds, or something like TLT, which is a 20-year proxy for the 20-year treasury. Those kind of things, I think, in the next year will do fine. So for those that maybe are a little more risk averse, there's a lot of people steering away from the bond market right now because they fear rates are headed higher. I tend to think rates are going to come back down here.
Well, thank you so much for all of your perspective. If you want to follow David on Twitter, his handle is @Dave H. Contrarian. I'm going to link all of his work below in the show notes. And David, again, thank you so much. I hope to chat with you again soon.
Yeah, thanks, Natalie.
Thank you so much for watching. This show is also made possible by iTrust Capital, where you can save in Bitcoin for your retirement. iTrust lets you invest with the tax benefits of an IRA. You can defer taxes on gains using a crypto IRA, or with a Roth IRA, you can withdraw tax-free at retirement. And here are some important things to know. iTrust does not lend against client assets, and iTrust accounts are FDIC insured up to $250,000 US. So if you're doing retirement planning and considering adding Bitcoin to your portfolio, you can sign up for an account and get a $100 bonus at itrust.capital/Natalie Brunell. Thank you so much for watching the video version of this show. I really want to hear from you. If you have suggestions or guest recommendations, you can email me at natalie@talkingbitcoin.com. Please subscribe if you want more content, and I'll see you next time.